If there are more people that want cars, then car prices go up. That's inflation. If the value of something doesn't change and the currency that I'm buying it with has been devalued, that's not inflation, that's currency devaluation. So if we had kept the money supply constant and we were all trying to buy a limited number of cars or houses, then you could call that inflation because the price is rising because supply and demand get out of whack. If the price is rising because the currency got cheapened, meaning we had $1 trillion on the left side of the table, we put $1 trillion on the right side of the table, now we got $2 trillion, the value of the money just went down by half.
Mark Yusko discussed the state of the market while a guest on the Matt J. Moore program. To combat inflation, the Federal Reserve has been raising interest rates. In June 2022, rising gas, food, and rent prices propelled U.S. inflation to a level not seen in 4 decades, putting more pressure on households and possibly paving the way for another significant Federal Reserve interest rate hike, which would be followed by higher borrowing costs. The largest 12-month increase in consumer prices since 1981 occurred in 2021, when they increased by 9.1% as compared to the previous year. The Federal Reserve raised interest rates to combat inflation, but investor Mark Yusko adopted a contrarian stance and asserts that he doesn't think we are now experiencing inflation. According to Mark, inflation happens when the supply and demand for a good or service are out of balance. Prices will rise if there is greater demand than there is supply. Nonetheless, Mark thinks that the inflationary climate that has been produced has more to do with the depreciation of the dollar than it does with the fundamentals of the economy. Mark thinks it makes sense to invest in tangible goods like gold and Bitcoin for this reason. Listen to Mark's perspective first.
So I have a nuanced view on this. I actually don't think we're experiencing inflation. And people say, oh, no, of course we're experiencing inflation. Haven't you seen egg prices lately? Well,
egg prices.
The point is, the eggs didn't get better, guys. The money got worse.
Right.
So what happened is, we had I believe, the greatest policy error in the history of policy errors, and I mean in all of history, in the lockdowns in response to the COVID crisis. And that set of circumstances led to an even bigger policy error, which was the monetary policy error to create half. Just let that number sink in for a second. Half of all the dollars that have ever existed in the history of our republic, right? So we've been a republic for 247 years now. Half of all the dollars in that 247 years were printed from 2020 to 2021. And because of that, everything appears to be rising in price, but it's really not, right? According to Zillow, right, my house that I live in here in North Carolina went up 40%. Well, my house didn't grow. It actually didn't get more efficient. It actually wore out a little bit. I had to put some money into it. It didn't get better. The money got worse. So money got devalued. There's a very big difference between inflation, 1970 style, I lived through it, where there was excess demand and limited supply, and monetary debasement, which is what we're doing right now through bad monetary policy and horrible leadership. So that's the difference. And so this number that everybody's freaking out about only went up last year because there's a 16-month lag between when you print a dollar and how that dollar gets into the economy and gets measured by CPI. Most of the CPI increase last year was 2 things. The price of oil. Oil went from literally 0, right? It was actually negative prices in April of 2020 for a few nanoseconds, to $120. And so let's say it went from 40 to 120 steady state. That's a trebling of oil prices. That's a lot of quote unquote inflation. Well, for the year last year, oil was dead flat, went from 75 to 75. So there wasn't a lot of inflation. The other part of inflation in CPI was used car prices. Now, used car prices happened because of the stupid lockdowns and the stupid supply chain disruption. You couldn't get chips for cars, and that's still a problem. I'm still trying to get, I have a 6-year-old Kia Niro, and I want to get a new Kia Niro. I like my Kia, but I can't find one because there are not enough chips. So used car prices, though, are collapsing all around us. And so most of the things that made up the high CPI number are now going away. And interestingly, money supply growth has totally reversed for the first time in 60 years, right? I'm going to turn 60 this year. So it's the first time since I was born, money supply growth went negative. And that negative is going to show up in the CPI number 16 months out. And so, the long answer to your question, Eric, is, by the end of this year, inflation will be sub 2%. The CPI will be sub 2%. We won't be talking about inflation. We'll be talking about deflation again. Because here's the thing. Every single day in this country, 10,000 people turn 65. And it turns out 65 to 85-year-old people are not as productive as 45 to 65-year-old people. They're perfectly nice people and wonderful. But in terms of the way we measure productivity and the way we think about growth, it's just a different part of life. And so we can't stop that, right? We can't make ourselves get younger, and we're actually going the wrong way with immigration policy. So, and even immigration doesn't help because the average immigrant's about 33 years old, and that doesn't fix the problem. You need 45 to 65-year-olds to improve productivity and working age population growth. So we're going to have lower GDP growth. We're going to have high risk of deflation. And the last part of it is, again, every single day in this country, 10,000 people turn 71. And at 71, or 71 and a half, actually. And at 71 and a half, you have to start withdrawing from your IRA and retirement account. And so what was a net inflow into equity markets over the last 25 years is now going to be a net outflow of about $1 trillion, with a T, dollars a year. And just remember, $1 trillion. We throw the T word around a lot,
right,
and it doesn't really have impact. $1 trillion. The three of us would have to stay on this show for 31,710 years, which would probably be most unpleasant.
Right.
Okay. Especially for the listeners, right? And we have to spend $1 every second. $1 a second for 31,710 years is $1 trillion.
Yeah.
So $1 trillion is a big old number. And we're going to withdraw $1 trillion from equity markets, and that money's going to go into bonds. So it's going to put pressure on interest rates for the long term, and it's going to put pressure on inflation, because inflation roughly matches working age population growth, which is sub 1%, and productivity, which is sub 1%. So that's where we're headed. And we won't be talking about inflation, but what's going to have to change, and this is the big reason that you've seen such pressure on Bitcoin, gold, et cetera, is monetary policy last year was negative, right? The Fed raised rates, they withdrew liquidity, they did QT instead of QE, quantitative tightening, and that caused, the dollar to rise. Through October, the dollar went up 18%, and that exacerbated the problem. Because remember, Bitcoin, gold, it's an interesting thing, right? Gold, we don't price gold in gold. We should, right? Because an ounce of gold has been a perfect store of value for 5,000 years, right? 1 ounce has bought a fine person's suit for 5,000 years, from Cleopatra's time to a suit of armor to a zoot suit in the 20s to Savile Row today. You take 1 ounce of gold, you get a fine person's suit.
Right.
So that's a perfect store of value. Now, Bitcoin is, I think, the future store of value because it's digital gold. It has all the properties of gold: scarcity, durability, but it's more portable, right? I can send you one. If I had a brick of gold here and I tried to break it into 3 pieces, it would be really hard to do. And even if I could do it, which I can't, I couldn't stuff it in my computer and send it to you. I can send you 1/3 of a Bitcoin in a heartbeat using my cell phone. So it's a better form of gold. And I think it will be digital gold for the foreseeable future. But we don't price gold in gold, we price it in dollars.
Right.
So here's a couple fun facts. So everybody says, oh, stocks have been awesome. Stocks are great. Really? Well, stocks made nominal highs a year ago, and then they went down a lot last year, and they looked good the first couple weeks of January. But that's because we price it in dollars.
Right.
Price it in a devaluing asset. Well, what if we priced it in gold? Stocks have been dead flat since 1996.
That's a
since
good
I
point.
made that investment in Google, right? Dead flat, priced in gold. What if we priced it in Bitcoin? Since Bitcoin was started in 2009, it's like pennies on the dollar.
Right.
Bitcoin's up, and And again, one Bitcoin is one Bitcoin. Bitcoin doesn't go up, it doesn't get better, it doesn't get more efficient. It just exists, but it's priced in other currencies. So here's an interesting fact. There has never been a bear market in Bitcoin in Turkey.
Right.
Priced in Turkish lira. The price only goes up. How about Venezuelan bolivars? Price only goes up. How about in Argentinian pesos? Price of Bitcoin only goes up. There's only been a bear market in Bitcoin where there's fluctuation relative to the base currency, the dollar, the euro, the yen. And so since October, what happened? Right. Since October, DXY has rolled over and has gone straight down. The dollar is crashing.
Compared to other fiat currencies, right?
Compared to other fiat currencies, right? But what's happening versus Bitcoin? Bitcoin's going up. Well, wait a second. In fact, Bitcoin is the best performing asset in the world this year. As great as, Peloton and all the crappy stocks that are recovering from being down 95% have done here in January. In a big short squeeze, Bitcoin's done better. Now, part of that is Bitcoin's gone through its own short squeeze as well,
right,
in the last week or so. But anyway, that's a long answer to say you have to think about inflation for what it is. And what we talk about in the news isn't inflation, it's currency devaluation.
Do you agree with Mark's viewpoints in this case? In relation to inflation, do you concur with this assessment? Utter a comment by pressing the like and subscribe buttons below. If you thought the content was worthwhile, please think about liking and subscribing to our little channel.